G'day there, Investorholics. Welcome to another ETF Spotlight Review. Today we'll be taking a closer look at IJH, which is the iShares S&P Small-Cap ETF, brought to you by the fine people at iShares, which is owned by BlackRock. So this one might be of interest to you if you're looking to focus part of your portfolio on small companies in the US. Might be appropriate for customers seeking capital growth with a high to very high risk return profile. So if you're a short-term investor, this one might not be for you, and definitely this is not a one size fits all buy 100% type thing and let it set and forget. This is this ETF should be part of a more broader portfolio. Anyway, I think there'll be some interesting information through this one, so hang around. And yeah, we'll give you recommendations at the end. Hey there, Investorholic. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Yeah, just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okie dokie. The fund aims to provide investors with the performance of the S&P Small-Cap 600 index. The index is designed to measure the performance of small-cap US equities. So the S&P Small-Cap 600 seeks to measure the small-cap segment of the US equities market. The index is designed to track companies that meet the specific inclusion criteria to ensure that they are liquid and financially viable. As always, if you want to get more information about the index, you need to go to the index provider. S&P is pretty easy to find, so just Google S&P Small-Cap 600 and that'll take you to the website. So why are we bothering? This one will give you exposure to small US companies at a relatively low cost. And also you can use it to diversify your portfolio, so give you some international diversification. And also what we're typically looking for is some long-term capital growth opportunities, which I think you could quite possibly get with this one. Okay, so we're looking at a net asset value of $148.02. It's trading above that, $148.36. Had a rough market cap of $427 million. Management fee is pretty reasonable at 0.07%. You get a quarterly distribution, January, April, July, October, but we're not really in this. If you're going to get into this, you're not in this for the dividends, because smaller companies don't tend to pay a lot of dividends. So hence the dividend yield of 0.78%. So this segment of the market is typically known for being less liquid and potentially less financially stable than the large caps or mid caps. The index was constructed to be an efficient benchmark composed of small cap companies, I should say, that meet the investability criteria and financial viability criteria. To be included in the index, companies have to have over $850 million market cap. and no more than 3.6 billion dollar market cap. So I suppose when you think about a small cap stock in Australia, that's really sort of getting into the mid cap range. So that just gives you a bit of an idea. The S&P Small Cap 600 is designed to measure the performance of 600 small companies in the US, reflecting this market's segments a distinctive risk and return characteristics. The market segment is high risk, so if you do go into this, you wouldn't be investing a high percentage of your portfolio in this one. It'd just be a small percentage. Yeah, so sort of use that as a non-core part. So if you're using this type of investment as a sort of small percentage, you're limiting your downside, but also capturing any upside. Have a look at VISM, QSLM, and VTS. VTS is not a small cap. It's the Vanguard Total Stock Market, but we'll have a chat about that later. But as always, we need to be doing our research, so just looking at all the different alternatives and coming to a informed conclusion. Anyway, let's have a quick look at some of the companies. A bit of a mix, but we're looking at Macy's is pretty much the only one I recognise, to be honest. It looks like there's some REITs and other different things included in this index, so it might be worth doing some research on at least the top 10 holdings in that one. So it was listed on the 10th of October 2007, so it's had a reasonable run time so far. PE of 21.7, PB ratio, so price to book, of 2.18. I think there's probably better options in the market for the average investor. They should have a better long-term performance as well. Instead of a narrow focus, investors should be in fact broadening out their focus and looking at a long-term core portfolio holding. As with the mid-cap video that I did or I've done, it's worth having a look at. I think it's exactly the same. I think you should actually be broadening your horizon. Not focusing it down onto the smaller end. I think you should just buy the whole market, and that's why I sort of included VTS in the previous slide for research. I think it's a better option for investors. I think it definitely has better long-term performance, and your dividends better, and it's lower costs. So I think it ticks the three major boxes. So if you had invested your 10 grand into the fund in May 22nd of May 2000, you have a return now of 67 grand, so it's not too bad. So 575% total over the life. It's got a better since inception run than IJH, which is the mid cap. So since inception here, you're looking at 9.36, which I think isn't too bad. But I think VTS is still beats that out. 1 year performance is pretty good. 55.8%. That's pretty much on the back of your COVID crash, so it's coming out of that pretty well. So I mean, if you bought back in March 2020, you're probably doing pretty well now with your 55% rise. Always something to keep in mind. But yeah, I think there's better alternatives, and if you're really keen on the US market, I just buy the total US stock market, and then you can forget about it. I think that's got like 4,000 stocks or something in it. So yeah, I think just let Vanguard manage the whole thing for you and forget about it. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.